Hi, I am Jessie Lang, and today we are talking about how I went from an accidental landlord to over 75 rental properties in the Midwest. We cover hard money lending, private money, and we cover the BRRRR method that has allowed me to scale my portfolio to what it is today.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 505. My guest today is Jessie Lang, who got her start in real estate through house hacking over a decade ago. Since then, she's grown her portfolio from 11 to 75 doors using a focused BRRRR strategy. And she's doing it in the Midwest with a small remote team in a high interest rate environment. Whether you're trying to break into your first deal or build momentum with limited capital, Jessie's story offers a blueprint worth paying attention to. Jessie, welcome to the show.
Yeah, thank you so much for having me, Brian. Excited to be here.
Why don't you tell our audience a little bit about yourself and how you got started investing in real estate?
Like you said in my little intro, I am a buy and hold investor in Columbus, Ohio. I buy mostly single family homes, some small apartments up to 6 units, really within an hour kind of surrounding Columbus. I have built the majority of my portfolio in the last 4 years using the BRRRR method, but that is definitely not how I got started. I actually never even set out to become a real estate investor. It was, the classic accidental landlord story, and started back in Austin, Texas in 2012. So I've kind of been at this for a while, really only focused since about 2018. So 2012, I graduated college and society says you get a job, you buy a house, you get married, have kids, all the things you're supposed to do. I definitely did not do all of them, but I did thankfully buy a crappy little condo. It was $92,000. It had the grandma curtains and the shag carpet and the yellow linoleum countertops. I mean, it was the whole thing. And as I was living there and fixing it up, I had the bright idea to rent out some of the rooms in the property. So I was making, they were paying the mortgage, I was paying the bills, and went on like that for a couple years where I had my day job and, I thought I was doing pretty smart at this time. So a couple years go by and my partner and I at the time was one of the roommates. We ended up splitting up, and I knew that emotionally, it would be difficult to continue living there, that it would be crazy to sell it. It was like in the run-up of Austin, Texas. And then that I couldn't just have a mortgage with no one living there, right? So I moved out, and in the span of 2 weeks, I went from living my everyday life to having 4 college boys renting out my condo that I had put my blood, sweat, and tears into. And I joke that they could have ruined my real estate career before it ever got started, but thankfully they were good.
You moved out and you rented out you had 4 rooms, so you rented out by the room?
There were 3 rooms, 4 boys, which looking back, probably wouldn't do that again, but it was a 3-bedroom, yeah.
Was that a smart decision as far as being able to cover your mortgage and then finding somewhere else to live? Because obviously you had to live somewhere else at that point.
Yes, and it all happened so quick. And, I was comfortable renting out rooms to other people. So I actually just rented a room from a friend for 6 months while I saved up money to go and buy another house, because that is my story. I did this 2 more times over the next 2 years. And at one point I had roommates where I was living, 2 long-term rentals, plus my day job. And I'm, mid-20s, and I'm, think that I'm the smartest person for figuring this out.
It sounds like you found out multiple ways to create streams of income, whether it be house hacking, where you're still living in the house but renting out a room, or just renting out the whole house. Did you ever do any vacation rentals during that period?
Not during that period. I did dabble in what's now like a pad split model where you're renting out by the rooms, like furnished bedrooms. We did not have pad split as a platform at that time, so it did not work out. But that other than that, it's been long-term rentals.
So your timing was good. I mean, being in Austin, Texas, 2012, I'm sure you could still buy at a decent price and then watch that run up happen over the coming years. I mean, what do you still own those properties?
We don't. I had 3 at the most, and they've all 3 since been sold for various reasons. One to kind of fund some personal travel that we'll talk about, one to help me get my active real estate business off the ground, and then the other just because I was losing money every month because property taxes were just crazy and rent wouldn't keep up. So I had a lot of equity and I moved that money from Texas up to Ohio.
Let's move to Ohio now. So, I mean, people might say, all right, you got lucky in Austin because your timing was good. Now, obviously, your timing was good, but you still had big expenses like property taxes that in one case, you weren't making any real cash flow. But you got to participate in some of that run up. So I'm sure when you sold the properties, were you able to make a profit?
We did, yes. We made, depending on the property, between $1 and $200K per.
How much?
Between $1 and $200,000 per property.
Okay, well, there you go. So maybe you had negative cash flow, but you made out in the end. So good timing there. But now you're in the Midwest, Columbus, Ohio, that area. And, can people really say over the past 4 years that your timing was good? Because it's been a tough market for a lot of real estate investors. So talk about that. Like, how long have you been investing in the Columbus, Ohio area? And what is that like right now?
I didn't actually set out to move to Columbus intentionally. I didn't, analyze all these different markets and decide this is the perfect place to be. So back in Austin, I was running this model up through 2016. I got this wild idea that I was going to quit my job and go travel the world. And so I quit and I went to live in 12 countries for 1 month each. I was with a traveling group of friends, and it changed my life in probably every way you can imagine. I met my gorgeous wife, who, we've been together 10 years now. And I was introduced to the company that brought me here to Columbus. And so I still, even with 3 rentals and they afforded me the option to go travel the world for a year, I still didn't see myself as a real estate investor. I still didn't think this was like a career choice. And so I moved here to work for a company. And when we were deciding to move here, we did a couple Google searches. And of course, I looked at the real estate and I was like, that looks good. Things are inexpensive. Like, let's do it. And since then, I've learned that I've never really kind of felt that I was more at the right place at the right time for the growth happening here. It feels very similar to Austin. I moved here on a whim. I moved here, I didn't even come visit. First time I traveled to Columbus was with my dog and my car full of stuff. And so I drove in and I'm like, hey, this basically just this feels like Austin. It was immediate, but 15 years ago. And so I was like, okay, this is going to be good. And I, since then, have been trying to buy and hold every single thing that I can.
Tell us a little bit about Columbus, why you like it, and how you got started investing in it. Like, what was your first property?
I love Columbus. It feels, like I said, very similar to Austin. It is, the blue dot in the red state, capital city, university town. We have the river through downtown, very similar, just lifestyle and people. And so it's a great place to live. And other than the winters, which debatably are not even that bad, even as a Texan saying they're not that bad, that says something. And so outside of the winters, it is a great place to live. And that attracts corporations, that attracts, people who want to come to OSU and then they get a good education. They never leave. So we have a very wide variety of kind of interesting people being attracted here.
You moved to Columbus, and then what made you say, okay, I'm going to now start the next leg of my investing career?
I, like I said, moved here to work for someone else. And I made it about 18 months before I was up for kind of an annual review and a position. I was, I will spare you all the details, but incredibly qualified for this job. I was doing a really good job. And I was asking for a very modest pay increase and was denied for like budgetary reasons. And it just was so clear that no matter what I do, it's never going to pay off. And I can work so hard for someone else, or I could take the chance on myself. And so that was August 2018. I went full-time real estate. I sold a property in Austin in order to kind of get some seed money, which turns out I didn't even really need. And I was wholesaling everything for the first couple years. I was handwriting letters at my kitchen table, doing my own cold calling. I mean, really just like every single thing that you see. And I did like a little wholesale academy type thing. And every single thing they were like, do this, I did them all. And finally it took 6 months, but got my first deal under contract. And yeah, it was off to the races after that.
It sounds like when you asked for that raise and they didn't give it to you, you just quit. Is that what happened?
I gave them 60 days notice, which is so generous. And I wrapped up all of my projects and I said, I'm going to go do my own thing. Yeah.
Did they say, oh, sorry, we should have given you the raise?
No, it was at a brewery, which is a desirable place to work. So it was, someone would fill my position right after me. It wasn't like the most desirable.
When I still had a W-2 job, I always felt like if I'm going to go in and ask for a raise, they're either going to give it to me or I'm going to leave. because once you ask for it, you can't take no for an answer. I think my attitude is a dangerous attitude to have, but that was my perspective on it.
Well, it got you here, so it must have worked out.
Yeah, and it's worked out for you. So you got into the wholesaling, but you did build your portfolio from 11 to 75 units. So kind of take us through that progression. What did you like about wholesaling? What did you not like? And then what was the next type of investing you began?
So wholesaling, I mean, it's easy to like the money, but it is a grind. I think that people underestimate. Have you ever done wholesaling?
No.
So I think people underestimate like how much goes into it. I'm sure you've seen in your local community or nationwide, oh, wholesalers are making all this money. And it's like, you don't know what it takes to get one property under contract. You see these big operations doing 10, 15, 20 deals a month. Like that is a lot of work. It's a lot of money invested in marketing. And so I was in that kind of marketing world for 4 years and got just frankly like burnt out on it. And that was 2022. But those first 2 years, I was selling all my contracts. I just didn't understand how hard money works, how other people's money, private money, I didn't understand how my buyers were actually buying. And so I was still buying rentals, but I was doing it the wrong way. I was saving up my wholesale income. I was putting 20% down on a rental. None of the renovation cost was covered. So I was coming out of pocket for that. I was skimping. I was doing the wrong renovations. It just was pretty messy and slow. And so it was January 2021 that I got a mentor. And I really uncovered like the BRRRR method. And so that's what I've used to scale the portfolio. I say the hard way, I got up to 11 doors. And then that first year, we bought 22 more. So 33 doors, 2/3 of that was in a single calendar year. And it was all because I figured out how to use other people's money.
And you got a mentor who helped you figure that out. So big leap there just in that year period. So you started off with your investing, doing it kind of traditional financing. You put your 20% down, but using other people's money really helped you accelerate.
I had the deal flow coming in for my own deals. I just didn't know how to keep them and how to not keep money in them.
So tell us how.
The BRRRR method, I did not personally invent. I think it was coined by Bigger Pockets 10, 15 years ago as well now. But it stands for you buy, renovate, rent, refinance, repeat. So we're buying under market value, using other people's money. We're forcing the value of the property through a good sized renovation. We're focused on function, safety items, cosmetics, mechanicals. I'm looking for 10 years of little maintenance, low to no CapEx. And then we're putting in a market rate renter. We're taking this whole package to a long-term lender, getting it refinanced. We'll say, how much will you lend me against this new package that I created? Typically, it's 75% of the new appraised value. You pull that money out, pay back your hard private money, and then if you BRRRR correctly, have 25% equity in the property with none of your own money, or you can even get money back at refinance.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. It sounds like a great formula, and it seems like it's working for you in reality. I mean, is it that easy? Is it that smooth?
There's a lot of moving parts, but I mean, honestly, it is because I have it so systematized. We do the same flooring, the same paint, the same hardware. I use the same crew. I've used our GCN the last 40 or so projects. It is very, very repetitive. There are moving parts, but again, it's just the same thing over and over.
And is this all in and around Columbus, Ohio?
Yeah.
So you're in your own backyard doing this?
Yes, in my own backyard. But I will say, because I talk to people all across the nation, and everyone has this like fear of investing remotely, which I totally get it. I basically practice remote investing because I don't personally go to my properties very often. I go to the final punch list when we first buy something, and that's pretty much it. I have, contractors. I have one full-time employee here, and between them, like they really kind of run everything.
Take us through your systems then. Let's start with the pipeline. Like, how are you finding these opportunities?
So right now we're doing some direct mail and some like pay-per-click. I do some pay-per-lead where someone else does the pay-per-click and you just buy the lead. We'll get the property under contract. We go through a title company, everything like you would. I'll either wholesale it or keep it. And if we're keeping it, my GC walks it before we close on it. The day after we close, assuming that it's vacant, the day we get possession of the property, they start. They budget timeline-wise $1,000 a day. So if it's a 40K reno, it should be done in, a month and a week. And then we get professional photos taken. We send it out to the market. It's rented. We're not super eager to take the very first renter that comes along. So I think some people think that, we budget 30 days to have someone like through our whole screening process and moved in and like rent coming in. So 30 days later, rent's coming in. As soon as I have my seasoning period met, then I go refinance it, and I just keep doing it again and again.
Let's talk about the refinancing and the financing in the first place. I'd assume you're going to private money lenders or hard money lenders or whatever. Tell us about that. Like, where are you getting the funds to close and renovate the project? And then I'll have more questions for you.
So the simplest answer and the one that I recommend for most newbies is actually using hard money. Now, hard money, you are going to need a little bit more of your own cash in the deal, but they have systems, checks and balances. Like if you think from a lender's point of view, they're not going to lend money on a bad deal. So it's just a second, third, fourth set of eyes who's making sure, hey, this deal's solid. I'll lend on it. Once you get better at that, I try to use private money as much as possible because I'm getting 100% of the purchase and 100% of the rehab covered. So I'm coming out of pocket with none of my own money. And I can just, like, honestly, I can underwrite a deal in half an hour, have it funded with a couple text messages and closed in a couple days.
What's the difference to you between private money and hard money? Like when you say hard money, are you going to a company that is providing the money versus just a private investor? And I still don't understand why one is preferable over the other to you.
Hard money is a company. They're typically going to be a little bit higher rates, but honestly, we pay our private lenders very competitively. So I may even pay my private lenders a little bit more than current hard money rates. And so you just have more of a process. There is often an inspection that the bank needs to send someone. There is a whole scope list that you have to fill out. There's draw schedule where they're not releasing the construction funds until...
That's if you go the traditional route to a bank and everything, right?
No, this is hard money.
You appreciate this process.
I think for a new investor, I do, because it's keeping you honest, right? Someone's checking your after repair value. They're checking your rehab scope. They're checking all this. I do use hard money if our private money is tapped up, but I always prefer private money. It's just, I'm telling you, I can send 3 texts and the money's like at account.
With the hard money?
With private money.
With private money, okay. Do you prefer the private or the hard? Because I hear you making an argument for hard.
So I personally prefer private money, but I'm a seasoned investor. I'm saying that for a newer investor, there are some benefits to hard money.
How did you create the private money relationships that you have right now?
So actually, one of my best sources of private money to this day has been sellers that I bought a large property from them. One started where he had 10 condos that he wanted to sell, and we bought all 10 in the same transaction. He seller financed 100% of them. Yeah, so I was like, okay, well, we'll obviously buy these. But then I was like, hey, you're obviously open to this. Like, let's talk. And so he has probably lent on 20 of my deals, like a single individual. Another was a older gentleman who was just done with the rental business. We bought a 6-unit building from him. We bought it with hard money. And so he received proceeds. And I was like, hey, John, what are you doing with your, $400K proceeds over there? And he's like, well, I may just put it in a stock brokerage account. And so I explained, private money lending to him. You can be the bank. And he's done quite a few deals for us as well. Talk
about the seasoning period. Like, how long do you have to season it for before you can go and then put traditional financing? And how do you get past you can only do 10 under your name rule?
I mean, we moved on to DSCR loans a long time ago, debt service coverage ratio. And that's what happens after you max out your 10 conventional loans. And so if you're married, you can get 10, your spouse can get 10. I say buy an LLC, so I wouldn't buy in your personal name. But after that, you can move to debt service coverage ratio loans, DSCR. And they're based on the income of the property. And you can have, it's more of a commercial type product. So you can have as many of those as you want.
Do most banks offer that?
I don't know that most banks do, but I know that local credit unions will. I'm trying to think, like, would Chase give you a DSCR? I don't think that they would. But there's thousands and thousands of lenders out there. It's just more local banks or like specialty, like investor type lenders. A lot of hard money companies have actually started doing DSCR as well. So you can like even partner on the purchase, and then they'll like kind of refi in the same, obviously it's a new loan and all that. And you have to pay your fees and whatever, but it's just with the same company that makes it a little smoother.
And DSCR, so I'd imagine that allows you to purchase through an entity, so you can invest through an LLC and not your personal name.
Absolutely. That's a non-negotiable.
Debt service coverage, and just for our audience who isn't clear, that means the rent and the income coming in from the property is more than covering the mortgage, the debt obligation. After you have all your expenses, so it's after net operating income, making sure you have enough money left over to pay that. In Columbus, Ohio, then I would assume you are able to maintain debt service coverage ratios that will help you cash out and get all of your money back. What do you say to people in other areas of the country where prices are much higher and you might be break even or even negative on cash flow?
Come to the Midwest. What would I say? I mean, I would never buy something negative cash flow. So if that's the position you're looking at, you're going to have a really hard time finding a lender that will allow that. There are some out there, but really think about it. The trade-off, like that is a very risky loan for your lender. So the trade-off is you're going to have high points, high rate. It's just not really a very nice loan product in general. So I would not buy that. If I was dead set on buying long-term rentals and it didn't work in my own backyard, I truly would stop trying to put a square peg in a round hole and making it work in your backyard and just go to where it works. There's so many like cities and regions around the country that like it still works.
Is that your strategy and what you're doing right now is the BRRRR, and then keeping these properties, just holding them as rentals and continuing to build out your portfolio?
As long as humanly possible, yes.
What do you see in the next 5 to 10 years?
I joke that, I built the machine and we have all the systems, teams, people. It's very hard to turn the machine off. So I don't think that I would ever stop buying rentals. We are doing some more flips this year. Usually I do a handful. We're probably going to do, 5 or 6 this year instead of 2 or 3. So just a little bit more active income. I mean, some more, I'm looking maybe mid-size apartment buildings, like 20 to 50 units, but really nothing crazy. Like I enjoy my work-life balance. I have a lot of hobbies. I have a rich social life, and I was a workaholic for a very long time. And it took really until about a year ago to kind of get out of that a little bit and like slow down and like appreciate all the hard work we've put in. So I'm like, I don't know, probably different than most guests you talk to, but I'm not in a huge hurry to do a lot of new things. Like this works and we're going to stick to it and I'm enjoying it.
Tell our listeners how they would find out more about you or even get a hold of you.
I do have a free Facebook group where I have a live stream. It's basically a podcast, but live, and you can chat to me. So we can link that into the show notes. It's called Unlocked. It's the logo, Learn to Buy and Manage Long-Term Rentals. We do, freebies, giveaways, all that sort of stuff. So the Facebook group's great. Instagram is Jessie Lang Official. And then I have a little free mini course of the BRRRR method if you want to throw that in for the audience.
We'll make sure that ends up in the show notes too. What is your favorite hack or app?
Business-wise, I could talk to you forever, but I want to say one on a kind of a personal level. Years ago, I read The Miracle Morning by Hal Elrod, and he, I don't know, this book, it's like not this super sophisticated concept, but it has changed my life in so many ways. And it's basically a morning routine. It's designed to be an hour. Some days it can be, it can be less. Some days for me, it's more because I enjoy my gym time. And I mean, you journal, you read, you exercise, you meditate, you visualize. It's a whole system, and it's been just very transformative and helped me kind of keep some focus in my life.
I want to thank you for coming on the show today. And it's been a lot of fun just tracking your real estate investing arc from beginning sort of as a house hacker, sort of an accidental landlord, and then moving on to really discovering the system in Columbus, Ohio, where you're using the BRRRR method to build a portfolio up to 75 units and eventually a lot more than that. You've got very specific on a lot of your strategy, and I appreciate that. And thank you so much for having this conversation today.
Yeah, you're so welcome. Thanks for having me.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's higinvestor.com. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.